Thank you very much for joining us. I'm going to give it just another couple minutes here before we get started. We are expecting a lot of people in for this webinar, so please be patient. We'll get started here in just another minute or so. Thank you very much. Talk to you soon. All right, let's get started. Thank you very much for joining us today. This is a presentation on the reverse mortgage, a program that is gaining a lot of popularity, a lot of sort of new interest in this lending program, and this is really just a guide to understanding kind of the nuts and bolts of how the program ultimately works, for the financial advisory community. So. Thank you very much for joining us. Let's get into this presentation. My name is Ryan Ogata. I'm going to be your presenter today. I'm the Executive Vice President of Reverse Mortgage Lending for Guaranteed Rate Companies. Actually, we just went through a renaming of our company. We're now called Rate, so I do have to update the slide. But if you do have any questions about any of the content here, or you have a potential scenario that, for a customer that you want to kind of discuss a little bit more. My contact information is listed here. It's ryan.ogata@rate.com, and my phone number, 415-225-4003. Please do not hesitate to reach out. I'm happy to talk about reverse mortgages and, all their great applications, all day long. A little bit of housekeeping. This seminar does in fact qualify for 1 hour of continuing education for those of you who are CFP certified. Our sponsor name, Guaranteed Rate, the program name, mechanics of a reverse mortgage, and our CFP Board program ID is 324801. We are facilitating a lot of these presentations at various times, and so we're putting through all the continuing education credits in sort of chunk blocks. So please be patient with us. You should get your credits pretty soon, but if you don't, feel free to reach out and we will see what the problem is. So let's get into the presentation, and I always like to start with this slide, right? This is a quote or sort of presentation, slide deck, whatever you want to call it, that was pulled directly from Forbes, and I'm going to kind of read it verbatim. Higher expenses introduce additional risk to a retirement plan. Expenses may rise faster than fixed income, creating the need to either reduce spending or withdraw more money, possibly during a bear market. The Federal Reserve's response to inflation has been to raise interest rates, which may negatively impact the value of fixed income investments typically held by retirees. So this is a very relevant sort of piece of information, especially now. Right? I think everybody on this call can relate to the fact that everyday essentials from everything from Yeah, I know, my computer just freaking died.
Okay.
I apologize. I'm having technical difficulties, everyone. Please stand by. For that, I was having technical difficulties. Please give me 1 second so I can sort this out. All right, let's start this over again. I apologize, everybody. I was having some technical difficulties there. Hopefully it doesn't happen again. As I was saying, inflation has been difficult on everybody, right? Everyday essentials, groceries, insurance, all that stuff seems to be getting, more expensive. So put yourself, in the position of being a retiree and you're living on portfolio withdrawals. The rate of depletion of your, sort of nest egg has gone up, at an accelerated rate, and that nest egg may not, be large enough to sustain your cost of living expenses in, this sort of higher cost of living environment. You kind of compound that with the fact that, a lot of retirees have, it makes sense, right, to shift out of equities and more over into fixed income, as you get older, to remove some of that volatility. As interest rates have come up, the value of those fixed income investments have gone down. So the retiree has been hit with something of the double whammy, right? A higher cost of living and a nest egg that isn't necessarily what it once was. So this is why, we think that the reverse mortgage is especially relevant in today's environment right now. And it's something, you may want to sort of take a little bit more, time to further explore. Okay, the largest asset that does nothing, right? For the mass affluent, home equity is the single largest contributor to household wealth. As an asset, it's also illiquid unless sold or financed, right? When I talk about the mass affluent, right, this product obviously is not going to be relevant for, customers that may have, like $10 million of assets under management, right? They don't need this product, but they also represent, the upper kind of portion of the U.S. population. For everybody else, the average American that does own their home, their home equity is probably the largest contributor to their balance sheet, right? Maybe they bought their home 20, 30, 40 years ago, and they've seen, appreciation, help to increase the value of that home, right? That they're sitting on a large asset, but their options to really use that asset are somewhat limited. Right? Retirees with limited income looking for supplemental funds for lifestyle expenses. Under what circumstances does it make sense for them to leverage this asset? So we've got this, picture of a home that's wallpapered with $100 bills, right? So you've got all this value in there. However, your options to actually use that home are very limited, right? You can either sell it, in which case you get all the cash, but you've got to figure out where you're going to live, or you can finance it. The difficulty with financing when you're retired is that your income wasn't what it was, and most forward mortgage programs, in fact all of them, they require income in order to get a new loan. So enter the reverse mortgage. This is just a textbook definition that I'm going to read for you. A reverse mortgage is a financial product primarily designed for homeowners 62 and older with limited income to convert a portion of their home equity into cash while retaining ownership of the property or to purchase a new property. All right, we can use these to purchase new homes. The loans do not require any repayment until a maturity event occurs, and that's selling the property or moving out of the home. There's different types of reverse mortgages, but the most common is the FHA home equity conversion mortgage, otherwise known as the HECM. Some common applications of reverse mortgages: increase cash flows by paying off a mortgage and eliminating monthly payments. Right? Increase cash flows by setting up monthly distributions and creating an income stream. right? These two, sort of first applications here are quote unquote cash flow applications. In the first example, you may have a customer that has a balance outstanding on their home, but there may be just a lot of equity. They can refinance their outstanding balance into a reverse mortgage, and they don't have monthly payments anymore. Right? So the cash flow pickup there is not having to make a mortgage payment. Conversely, for the customer that may have no mortgage at all, right? They own their property free and clear. Maybe they have just a small balance outstanding. They can actually annuitize that equity in their home and create, something of an income stream in order to augment their cash flows. Another application is to just set up a line of credit to cover large one-time expenses, right? Home improvements, debt consolidation, medical expenses, tuition, college tuition for their grandchildren, right? This product, as you start to understand it, does in fact function very, very similar to a line of credit. We're going to get into kind of the mechanics of it a little bit later on. And the last one here is very relevant to, the financial advisor community and, mitigate sequence of returns risk, right? We are going to kind of make the case that the reverse mortgage, belongs as part of the, kind of comprehensive retirement plan, pre-tax, post-tax, maybe life insurance, right? There is a place for the reverse mortgage to kind of fit as a tool for a customer to leverage, depending on sort of what's going on in the market. Because there may be instances where they don't want to touch their portfolio and it makes sense to kind of leverage the property. So we'll get into all this stuff later, but these are kind of the common applications that we see for reverse mortgages. So very, very different than forward, right? What we have here, and I want to introduce this concept of financing that is based on age and interest rates, not income, right? When we think about a normal traditional mortgage, right, it's income that is driving how much a borrower is going to be able to leverage, right? In the reverse space, it's not income, it's actually going to be their age that's the driver. So I've got this, sort of graph here, and on the vertical axis, we've got this acronym LTV, and it's expressed as a percentage. LTV is an acronym for loan to value ratio, and what it represents is the percentage of leverage that somebody can get on a home, right? Like if I said there was a $1 million home with a 50% LTV, 50% of $1 million is $500,000. That would be, a $500,000 loan would be 50% loan to value. I've also got on the horizontal axis age, right? You qualify for this program as early as age 62, and we've got age 62 all the way through 99 displayed here. What you're noticing is that the older a borrower gets, the more equity in their home they're going to have available to them. And the last piece here is really, the impact of interest rates. I've got 3 different interest rate lines here to kind of illustrate the math of what's going on. One of them is at the 5% rate, and that's the green line. One of them's at the 6% rate, which is the yellow line. And then one of them's at the 7% rate, which is the salmon colored line. In a lower interest rate environment, right, it makes sense that interest, because these loans do not require any monthly payment, is going to accrue slower than a higher interest rate environment, right? Is if when interest rates are lower, that's less that you have to spend to kind of your cost of borrowing. So for that reason, a borrower will have access to more of their home's value when interest rates are lower versus when interest rates are higher. So again, forget what you know about mortgages. Very different than forward mortgage financing, your traditional like 30-year fixed, 15-year fixed, whatever people use to get into homes. This product works completely off of age and interest rates, and that's what is going to determine how much we're able to leverage on a borrower's property. But it's not safe, okay? I want to kind of start and kind of take this one sort of head on, right? I think everyone is aware of these loans having somewhat of a predatory past. They were in fact predatory loans. A lot of people got into trouble. All I can say is that big government has really stepped in to make the product a lot safer than what it used to be. And I'm going to argue it's probably one of the safest products financial products that are out there on the market. Most reverse mortgages are in fact regulated by the Department of Housing and Urban Development, HUD, and the U.S. government has been proactively adding industry safeguards to make the program better for consumers. So let's talk about some of those, right? The first one that I want to go over here is reverse mortgage counseling. So before submitting a reverse application, borrowers are required to meet with an independent third-party HUD-approved counselor. Reverse counseling is an impartial educational resource to help seniors and their family members make an informed decision about reverse mortgages. The process is mandatory for all reverse mortgage transactions. So, even after this, if after this presentation you think, God, reverse mortgages are the best thing, and you start, kind of advising some of your clients to maybe pursue it, and maybe you refer them over to, somebody at my company, Rate, and our sales team does a great job selling the product. Even if that customer wants to proceed, right away with getting a reverse mortgage, they can't. They actually have to meet with an independent third party in order to, go over the pros, the cons, make sure that they fully understand what it is they're signing up for, and that's mandatory. The next one here is, non-recourse protection, right? These loans are in fact 100% non-recourse, even if home values decrease, right? Again, like 2008, I think 2008, in the environment that we were in, where property values were plummeting, kind of across the entire country. Even if values decrease, the borrower or their heirs can never be liable for any amount over the value of the home. Why is that important? Well, these loans, you do not make monthly payments on these loans, or in fact, the monthly payments are actually optional. We'll talk about that in the next bullet point here. So that interest is, compounding, and the balance of the loan is going up. Again, the calculations that we use are very conservative in terms of, how much someone's going to be able to borrow on their property. But if we do find ourselves in an environment where, property values have just come down drastically, there could be, some market volatility at some point in the future. A borrower can never owe more than the home is worth, which is a great thing. Monthly payments are in fact optional on these loans. It's a big misconception out there. A lot of people think that, if you get a reverse mortgage, you can't make monthly payments and your loan balance is going to balloon on you. That is not the case at all. The borrower can choose to make a payment at any time. There's no penalty for doing it. In fact, we advise, if they can, to go ahead and make a monthly payment. Non-borrowing spouse protections. This is another big one. To be eligible for a reverse mortgage, only one borrower must be over the age of 62, except for the state of Texas. Texas does have a lot of weird carve-outs for reverse mortgages. In Texas, the only carve-out here is that, both borrowers have to be over the age of 62. But what's great about this is eligible non-borrowing spouses. So if you're under the age of 62, but you're an eligible spouse, you get to remain in the home without making any monthly payments, even if the borrowing spouse moves into assisted living or passes away. So, you may, maybe there's an age difference, one spouse outlives the other. The surviving spouse is afforded all of the protections of a reverse mortgage, regardless of being age eligible at the time that the loan was put in place. So another great kind of feature there. There is no prepayment penalties on these at all. The loan can be repaid at any time. You can refinance out of the loan. You can pay it off with cash, whatever you want. There's no consequence for doing it. And the last one here is interest rate adjustment caps, right? This is, for the most part, a variable rate product. There are some fixed rate options available, and we're going to talk about those later on. There are caps in place as to sort of how high rates can go, regardless of the fact that these are variable rate loans. So the cap is typically going to be 5% over the start rate. So mechanics, let's roll up our sleeves a little bit and talk about how these work. Two main programs, variable rate and fixed rates. The variable rate, right? So, similar to a traditional HELOC, right? A home equity line of credit. A variable rate reverse mortgage is a line of credit that can be drawn and repaid over time. There's no standard draw and repayment schedule. Proceeds can be taken as a lump sum, as a partial lump sum with remaining line of credit, as regular monthly payments to supplement a borrower's income, or any combination, right? This is the blank canvas of mortgage lending. At the onset of the transaction, the initial line amount, right? The line amount that we have, right? It's a credit line. The initial line amount is established based on the borrower's age, market
interest rates, and the property value. Income is not part of the criteria. So in general, older borrowers will qualify for more and younger borrowers will qualify for less. So I'm going to go back to the slide, right? It's starting to make sense. Think of this as, based on your age and what interest rates are, this is going to sort of set up or establish what your line of credit is going to be at the onset of the transaction. So if a borrower is, 80 years of age, as an example, and we're in a 7% interest rate environment, they're going to be able to borrow 45% of their property value, on the reverse mortgage. Similarly, if rates are a little bit lower, I think, we're all kind of crossing our fingers that interest rates, decrease a little bit, kind of in the near future. Hopefully it happens sooner rather than later. But, if interest rates are lower, we're going to give that customer, more equity, access to more equity in their property, and they'd be able to borrow, 53%. Right. So again, the older you are, the more of your home's value we're going to allow you to leverage at the onset of the transaction. This is in fact a growing line of credit, right? So it's very easy. It's good to think about this like the home equity line of credit. This is where it gets a little bit different, and it's for the better, right? So the total line amount of credit to the borrower will continue to increase at the same rate of interest that is being charged. This is called the growth factor. While there are no required monthly payments on the outstanding balance, any unpaid interest is added to the principal and the balance can grow over time. Conversely, any payments made by the borrower will open up dollar for dollar the same amount of available credit to be used at a future date. So what's so cool about this, right? And if I think about it in terms of an equity line of credit, is that, when I get an equity line of credit, and I have one on my home now, my credit ceiling, I'm just going to say it's $100,000, right? That is the amount that I am capped at, right? I can charge that credit line up, I can pay it down, I can do it all day long, but at no point can I ever exceed, that $100,000 cap that I have for that line of credit. Furthermore, there is a specified draw period on that line, right? It's a 5-year term or a 10-year term. And that after that term, the draw goes away, and I have to start, paying down the principal. Reverse mortgages work very, very different. Your line amount actually increases at the exact same rate of interest that you're being charged on the total line amount as time goes on. So the line amount actually gets larger, giving the customer access to more equity in their home as they get older automatically. Right, so here's a little kind of illustration of the different components of this. I've got a home value of $500,000. I'm showing appreciation here at 4%. Now, 4% is kind of the national average. It might be conservative for your part of the country. It might be aggressive, right? But more or less the appreciation over the long term that we've seen on real estate is 4%. Now, why are we talking about that, right? So that's this this green line. Right? We're seeing property values sort of go up. Well, this loan is negatively amortizing, right? And the balance will, assuming the borrower makes no monthly payments, that balance is going to get larger as time goes on. From a kind of consumer psychology standpoint, that's obviously a little scary, right? We work towards paying down all of our debt as we get older, and the thought of taking on a new mortgage, especially at this stage in life, gets a little scary. It's kind of important to highlight, though, that regardless of the financing instrument that's in place on a home, that asset should hopefully continue to increase in value. That property appreciation is working for you. So, you do have that as something of a counterbalance to the fact that you are putting a new loan in place. I'm also showing here a variable rate of 6.48% plus 0.5% for mortgage insurance, right? We do pay mortgage insurance on these loans on a monthly basis. So if we add the two together, we're really talking about a 6.98% cost of borrowing. Let's just round it up to 7. For this borrower's age, right, this credit line is going to start at $210,500. So I'm showing that here as the yellow line, right? This is the line amount that, as you're seeing, the total amount of credit that's available to this customer is increasing over time, and that line amount is going to grow from $210,500 let's just assume they stay in the loan for 20 years. It could be as high as $800,000 at the end of this. And the last piece, because we are talking about this in the context of an equity line of credit, is the draw, right? A $100,000 draw with no monthly payment. The interest is being added to that $100,000 every month. Let's just assume they don't take any more money out, but they just want to let that balance kind of sit there. It's going to get larger if they're not making any monthly payments, and that's also going to go up, right? So think about it very much like an equity line of credit. Now, this is where I kind of want to introduce a little bit of volatility into the illustration that we just looked at, because this is the real world. Home value of 500,000. Value appreciation, 4% is the average. For those of you who have been around long enough, you know that 4% isn't sort of guaranteed every year. It kind of has a interesting path of getting there. Going back to 2008, you might see property values pull back a little bit. Maybe they flatten out a little bit. Maybe they start to shoot up, right? But I think 4% is a good kind of long-term projection. Moreover, this is a variable rate product. So this line amount, right? Remember, it will increase at the exact same rate of interest that's being charged. So in higher interest rate environments, the total line amount itself is actually going to grow faster. In lower interest rate environments, the line amount is going to grow a little bit slower, right? So again, it's going to go up and down. The rate of growth goes up and down depending on the interest rates. Now, what you're probably noticing in this graph is something that's kind of unique. And I put it here on purpose to illustrate just another kind of great thing about reverse mortgages. You've got a line amount or total kind of potential financing that actually exceeds the value of the home, right? You've got the yellow line here that's above the green line. An equity line of credit, going back to myself, 2008, I had an equity line of credit then, and even though I wasn't using it, I got this nice letter from the servicer stating that their analysis of property values in my area was that they were going down, and even though I have perfect credit, even though I'm not using the equity line, they were closing it out for me, and thank you very much, but we don't want your business anymore. That cannot happen with a reverse mortgage. That's what this mortgage insurance is in place for. Regardless of what's going on with property values, the customer is effectively guaranteed that increase in their amount of credit that they have available to them, and that will go up regardless of what's happening with property values. The last thing here, really that balance outstanding of $100,000, just showing that in higher interest rate environments, it's going to go up a little bit faster. It might taper off, but assuming they're making no mortgage payment because this product doesn't require one, that's what would happen on that $500,000 balance. Excuse me, on that $100,000 balance. So income applications, right? This is a very, very common use of a reverse mortgage, to provide the borrower with an additional source of income. Income payments can be accomplished in two ways, either tenure payments or term payments. A tenure payment is the same monthly distribution for the life of the loan. The payment is guaranteed for as long as the borrower continues to live in the property. Right? A term payment is a monthly distribution for a specified period of time, 5 years, 10 years, any time frame. The calculation is designed to give the borrower the desired amount, up to the maximum, right? They can't just take, $10,000 a month out of their home. It's not going to work, kind of thing. For the duration of the term, right? We run a calculation. If they say, hey, I want to max myself out over a 10-year period, we can run that calculation. The cool thing about this, like I said, these programs are very, very flexible, is that the borrower can cancel or modify their payments with the servicing department at any time. So just because they say, hey, we want this 10-year payment, slow and steady, we're going to be in this property forever, maybe their plans change and they want to kind of pull some cash out, or maybe they say, hey, we want to give this loan a little bit of a rest. We don't want to pull on it anymore. All they have to do is pick up the phone, call servicing, and we can modify their terms of their income distributions. So looking at this graphically, again, it's the same home value, same appreciation, same growing line of credit at 210, 500, right? But what I'm showing here in this case is that instead of the borrower taking a $100,000 draw, we've got a 10-year monthly income calculation here, $1,344, starting at zero, right? It's going to go up by $1,344 every single month, and the interest is compounding on that. right? But if you look at this, it's kind of, the calculation is intentionally designed for over this like 20-year horizon, for this reverse mortgage. Maybe it's longer. The line amount and the draw on this are ultimately going to converge. They're getting closer and closer, as time kind of goes on. With the ultimate loan is done, going to be paid off, for those two to become one and the same, right? The calculation is designed, for wherever someone's life journey is, to what kind of a realistic expectation of either their life expectancy or when the home is going to be sold, right? We're trying to mirror the two and get them as much cash as possible. Using the term payment option, by contrast, what I'm showing here is a 10-year term. This customer wanted to get the maximum out, over a 10-year period. So look, they're going to get more money, right? It's almost it's like what, $900 more, $2,210 is what the calculation yielded. So what you're seeing here is over the course of 10 years, right? They're taking their distribution, the interest is being added. After 10 years, they've maxed themselves out, right? And they can no longer get income out of this home because the equity line itself is maxed out. They don't have to make payments, but the income distribution goes away. And if you'll notice, the balance in the line amount, because the line is sort of fully drawn at this point, are obviously continuing to increase at the exact same rate. Now, like I said, this is an equity line of credit. So let's just assume, around year 15, maybe there's a windfall event of some sort, who knows? The line amount is going to continue to increase, but then they have, $200,000 they paid down on this line of credit that they can draw on at a future date. So very, very flexible program. Shifting gears a little bit, let's talk about the fixed rate, kind of version of this. So think of this product very similar to your standard 30-year fixed rate mortgage. The fixed rate reverse accrues mortgage interest at a set rate that doesn't change for the life of the loan. The borrower takes a single lump sum disbursement at the close, and monthly payments are optional. Mortgage interest that is not paid monthly will be added to the balance. Okay, so great. It's a fixed rate product for the more financially conservative. Here's the catch. Unlike the variable rate program, the fixed rate option is not a line of credit. It is a closed-end mortgage program. Any payments made towards principal will reduce the outstanding loan balance, but are not eligible for withdrawal at a future date. The only disbursement that the borrower will receive is at the time the loan funds. The most common application is to refinance an existing mortgage balance outstanding, right? So this is for the customer that may have a small balance outstanding that they just don't want to make payments on anymore. They may be a little bit more financially conservative and they don't like the idea of fixed rate loans. Remember about this age demographic, they experienced the 80s with, really, really high interest rates. Maybe they just don't want to expose themselves to that. Even though we have that cap that's in place, right? But for whatever reason, still some people do opt to take this product because it is a fixed rate. But remember, it's not a line of credit. It's a lump sum disbursement. So looking at this graphically, not that exciting. Same home value. The interest rate is fixed, so it is going to be a little bit higher, on any given day if you compare it to the variable rate option. But and because the rate is higher, the loan amount is a little bit smaller. So in this case, $182,500 was the maximum lump sum that the customer could have taken, assuming they're not making any mortgage payments, right? That balance is going to go up. But because we're, typically refinancing a loan that they have on the property, the cash flow savings is really the fact that they don't have to make a mortgage payment anymore, right? So that's the benefit to the customer. There is actually a really cool second mortgage for those of you who are familiar with the second mortgages that exists for this product. So similar to your standard fixed rate second, it's a home equity loan that allows a borrower to access funds without paying off an existing first mortgage, right? Most, if not all, reverse mortgage loans have to be a first lien product. This one does not. And when you think about, kind of the environment that we're in right now, a lot of borrowers secured long-term mortgage financing in the 2.5% to 4% range between the years of 2020 and 2021, right? There was a massive refinance boom that happened. And, a lot of customers are sitting on small loan balances with very, very low rates. This is the product that allows them to keep that low rate first mortgage, but also access additional equity in their home with no monthly mortgage payment. You can access the loan amounts can be anywhere from 50,000 to $1 million. It's available in Arizona, California, Colorado, Connecticut, Florida, South Carolina at age 55. Here we go, Texas again with another exception. Got to be 62, but it is available there. And another caveat is that the first mortgage that it goes behind does have to be a fully amortizing loan. So adjustable rate mortgages are okay, but not if they're of the interest only flavor. Look, the demand for this product is increasing, and I fully expect the list of eligible states that we're offering this in to increase very rapidly. I would say, the West Coast is probably going to be first. Washington, Oregon, I don't know the exact timeline on it, but it would likely be probably in the next month or so that you're going to see more states allow for this product. Another cool thing is that the current rate for the program is 9.99% and it's fixed. So again, relatively speaking, in the world of second mortgages, not first mortgages, second mortgages, 9.99% is a very aggressive rate, considering that this is in fact a reverse loan. You don't need income to qualify for it. It does have a lot of flexibility, and the pricing is right compared to most second mortgages that are out there. You're not paying a premium for this product. Looking at it graphically, this one's a little bit different. This is an actual transaction example of something that we did not too long ago. This was in a high value market. The home's value is 1,800,000. Talking a little fast here, and the borrower had a $494,000 first mortgage at 3.9%, right? That's a great rate. There's really no need for them to pay that down any faster because 3.9 is a good product. It's a good rate to have. It's very aggressive, but they did want to get some cash out, so we were able to give them another, let's just call it $450,000, 449,920. Let's round up to 450 at 9.99% with no monthly payment. So when you're looking at kind of what's going on here, you've got the first mortgage that making payments on it, that interest is going to compound. Again, payments are optional. You don't have to not make payments, but worst case, the outstanding balance is going to go up. And then really this total financing line represents, if you add them to the two loans together, that's the total financing on so it makes sense that the salmon colored line and the yellow line are going to converge because the mortgage balance for the first goes to zero. So the only mortgage is in fact the total financing line, kind of as time goes on. But if you look at, 4% on this $1.8 million property value, we still have equity in the home, regardless of the fact that this loan's been in place for 20 years in this model. Closing costs for reverse, they are a little bit different when you compare them to the forward options. Mortgage IMIP, initial mortgage insurance premium, that is the biggest culprit to this. It contributes significantly. It's calculated at 2% of the property value up to the program limit of $1,149,825. Why that number is significant, right? So this program is designed for homes of $1,149,825 and below. It doesn't mean that you can't transact on a $1.5 million property. It's just that the 2% of mortgage insurance premium and the calculations that we do for how much equity in your home you can leverage are going to be based on that $1,149,825 kind of valuation. That number does increase every single year, so it will go up with time. If you are in a market where you've got property values that are much higher, like I'm in San Francisco as an example, like $2 million homes, are kind of the lower end of the market here. There are other programs that are available and they function more or less the same. It's just that this one that we're talking about right now, it caps out at $1,149,825, and that's to pay for that mortgage insurance premium. Relatively speaking, is that high? Well, I'm going to say it's not. When you understand, other mortgage programs, FHA loans in particular, which represent the other end of the spectrum, typically for first-time home buyers, the buy-in to that program is 1.75%, right? So this is really not that much higher for a government program. It's just a significant component to the closing costs. You also have the origination fee, which gets applied to these transactions. It can range from $2,500 to $20,000, depending on the transaction. Like I said, that we do these on luxury homes. Like we did one on a $20 million home in Santa Barbara, as an example. That one did have a $20,000 origination fee. So it is in fact, tiered to the value of the home, the fee structure. And then lastly, you do have the traditional third-party closing costs, title, escrow, appraisal, stuff like that. So let's look at some scenarios, right, and some applications. So I've got John and Jane Smith, who are a married couple aged 79 and 75. Their home is valued at $500,000, and they have a $148,000 mortgage balance outstanding, and they've got $450,000 in savings, right? They want to free up some cash flows without drawing down their savings or selling the home, right? That's the purpose here. So if I look at John and Jane Smith, right, it's actually the same scenario that we've been looking at, the $500,000 home value with the growing line of credit that's going to start at $210,500. It's based off of Jane's age, right? We take the lesser or the younger of the two borrowers to determine this calculation. So if I look at the kind of the slices of the pie, we're going to pay off their mortgage balance of $148,000. They've got some closing costs. I wanted to illustrate this one rule that comes into play with reverse mortgages. There are, in fact, limitations on how much of the equity line you are, in fact, allowed to draw on in the first year. This is a kind of a precautionary sort of protection mechanism that's built into the program. And for borrowers with significant payoffs, like this $148,000 mortgage, there's a rule that says in the first 12 months, you're going to be limited to 10% of your line of credit that you have access to. So 10% of $210,500 is $21,050, right? This is what's available to them the first year. Now, they don't have to take it, right? They could take it all at the closing table if they wanted to. They could take it on day, 360. But, as long as they have to stay below this threshold of total kind of leverage on that equity line of additional funds for the first 12 months. After that 12-month period, the remainder of the line of credit opens up in its entirety, and it continues to grow, right? So again, this is another example of how I think the loan program has gotten better. Even though it's an equity line of credit, you can't just like max yourself out, the entire loan balance the day that the loan funds. There are some restrictions on how much you can do. So if I look at a cash flow comparison for the Smiths, right? So their current situation, $500,000. They've got a loan balance of $148,000 and savings of $450,000. They don't have a line of credit. They've got a mortgage payment of $1,987, and they've got taxes and insurance of $760, right? But remember, they're short on cash flows in their current situation. So their first option is to just pay off the mortgage, right? They've got the savings balance to do it, right? If they take 148 and they pay it out of their $450,000 balance, they're going to be left over with net liquid of $302,000, right? They still don't have a line of credit, right? But they have no mortgage payment, which is great. And they're still on the hook for their taxes and their insurance of $760. But again, they've really kind of dipped into their liquidity here. And looking at the last option, this is the reverse option, right? So what if we were to refinance that $148,000, right? And we're going to roll our closing costs into the transaction. That's part of this. So they're going to end up with a loan balance outstanding of $166,840. Their savings is entirely intact because they just chose to refinance this loan, but they do get the benefit of an additional line of credit that will grow of $44,660 of additional funds to use for whatever they want. Furthermore, because it's a reverse loan, there's no monthly payment that's due on this mortgage. So they don't have a mortgage to pay anymore, but they do have to pay their property taxes and their insurance. So from a cash flow standpoint, they accomplish the exact same thing as having just paid the loan balance down from their savings. In this case, they get to keep their savings intact, and they also get to set up a line of credit. If I change this scenario around a little bit, I do want to kind of show another rule that comes into play for their disbursement limitations. So I'm going to significantly reduce their balance outstanding. Right? Let's just say they've got more equity and they only owe $48,000 on this property. right, and keep everything else the same. Well, because they've got so much more equity, right, the program guidelines do in fact lighten up a little bit, and they say, hey, you have access to more of this credit line because what you're paying off and rolling into it is so much lower. There's another rule that comes into play that says you get the better of, either that 10% limitation that we had in the beginning, or 60% of this total line of credit, 210, 500, multiply it by 60%. If I add these three pieces of the pie together, that's 60% of it. This is what we're going to give you access to for the first year. After that year of seasoning is up, the remainder of this equity line opens up to them and they have full access. Now, because this customer has so much more equity in the home, they may choose to pursue, an income application. And if I use just like a 10-year term, maybe they know they're going to be out of the property inside of 10 years, that calculation yielded $1,654 that they would get, every single month. So for a cash flow comparison for, them in this circumstance, if we take their current situation, the cash flows are the same, but the balance outstanding here is a little bit smaller. If we refinance that into a reverse mortgage, right, we have a growing line of credit that's added. So they got $143,660. Their savings is entirely intact. They've got no mortgage payment, and if they chose to take the income distribution, they're adding $1,654 to their cash flows. They're actually adding more, right? Because we're not paying this $1,987 anymore, and we're adding an additional $1,654. You do the math, what is that? About $3,600 in cash flows that they get to add every single month. So wrapping up here, I do want to talk about one particular application, and that's sequence of returns risk. We talked about this, in the beginning, very, very kind of briefly. Look, our thought is that, the reverse mortgage has a place as part of kind of a comprehensive retirement plan. And, it's not going to be, the loan of last resort that it has the reputation of being, where customers really only seek it out when their back is up against a wall. We think that, it belongs, pre-tax, post-tax, life insurance, as one of the tools that the borrower has, a bucket of funds that they can leverage depending on the market circumstances. So here we've got, Ernie and Rose that have retired at age 67. They've got a portfolio value of $900,000. Their plan is to draw $50,000 a year to maintain their lifestyle, and their $600,000 home is owned free and clear. We're going to look at what it looks like when they run out of money and they have to put in place this reverse mortgage. And then we're also going to look at what it looks like if they want to, establish this reverse mortgage in the beginning and use it in conjunction with portfolio withdrawals. So the first path here is, let's just not use the reverse mortgage until we have to. And what we're showing is, this $900,000 portfolio balance subject to market volatility, right? These are actual S&P returns in the tax years that we're sampling. And we're also showing the $50,000 draw that's going to be increased at 3.5% for cost of living adjustments and what that impact is going to be. So, look, we all know we don't want to sell into a down market. The unfortunate reality, though, for the retiree is that you gotta pay for your lifestyle expenses, right? The cost of your essentials doesn't go away. So you're basically forced to sell regardless of what's going on. The problem is that when the market bounces back, if we use 2002 to 2003 as an example, your asset base is that much smaller, and it cannot participate in the swing in the other direction where the market improves. So you've got various years here. 2002. I mean, everyone. September 11th, right? It was a dark time for the country. 2008. That was the mortgage implosion. My industry caused that one, but look what happened. The market really took a nosedive there. Over the next couple of years, though, it bounced right back. So you've got these sort of different moments in time where you're seeing kind of what's happening to their portfolio. They have to take their distribution, and look at this. At age 84, they run out of money. The balance left is not enough to pay for their lifestyle, so they have to get a reverse mortgage, right? Their house is the last asset that they have available to them. They can put that loan in place and they can kind of start drawing out the equity on that home. So look, they made it through life's journey, but let's present another kind of option. So let's just say we want to use the reverse mortgage in conjunction with portfolio withdrawal. So we're going to establish that line of credit right at the beginning. We're going to evaluate the portfolio performance at the beginning of each year, right? If the value has gone up, fine, let's take the draw. If the value has gone down, right, we're gonna leave that portfolio intact. We're not going to take the balance from there. We're going to use the reverse line of credit to give that portfolio some time to recover. So same returns, same scenario. The only thing that's different is that in the tax years immediately following where the market had retracted, we are going to leave that portfolio in place, not take any distributions from it, so the asset base is higher, allowing it to kind of recover, right? And if you notice, so like 2003, right after 2002, we took it from the reverse mortgage. 2009, great example, took it from the reverse mortgage. Fast forward this exact same thing with the exact same returns, and look at this. Even in a year where the market pulled back, almost 20%, they still have $505,000, $500,000 left in their portfolio, of assets, for you to manage, maybe get a better return on. We're going to make the argument that this is sort of the better path, right? Again, use the appropriate tool, during the right time, let the portfolio recover, and consider using this reverse mortgage as another bucket of funds to leverage when the market circumstances are better. So we've got portfolio preservation success, and they ended up with about $500,000. Probably a better place to be than to not have anything in the bank and have to get a reverse mortgage because you don't have any other options. That's pretty much the end of it. I want to thank you for attending. I do apologize for the technical difficulties. I had to unplug my laptop, reboot it, and kind of turn it on here. Not reboot it, but they kind of went into sleep mode. So I apologize for all that mess. If you're already working with somebody from Guaranteed Rate, please reach out to your contact. If you'd like to be connected with somebody to talk more about this program, please reach out to reverse@rate.com. Just shoot them an email and they will set you up with somebody local to your market that can maybe talk about this a little bit more. But I do want to thank you very much for attending. The housekeeping item, so you get your continuing education. If you want to take down this information again, Mechanics of a Reverse Mortgage is the program name, and our CFP Board program ID 324801. Again, my contact information, Ryan Ogata. My email, ryan.ogata@rate.com. My phone number, 415-225-4003. Please reach out if you have any other questions regarding this. Like I said, we are facilitating the continuing education in batches, so we'll put it through. Please be patient with us. But if you don't see that education credit, come over to you shortly. By all means, reach out and we'll investigate what happened. Again, thank you very much for attending, and please reach out with any questions. I hope you found this informative, and have a good rest of your day.